Now that you have learned the fundamentals to calculating present value by discounting cash flows, we're going to start applying those lessons to financial decisions. Specifically, how does a manager know when to accept a project and when to decline one? What follows is a number of rules financial managers can use to help them select projects that will be a good investment decision. What we mean by a good investment decision is one that will increase the value of the company. In this lecture, we're going to learn how to calculate the net present value of a project, use the net present value rule to make an investment decision. We will have a look at alternative decision rules, their advantages and their disadvantages. We will distinguish between standalone projects and mutually exclusive projects. And finally, we will have a look at ranking projects when a company has limited resources. So the net present value rule for standalone projects. Well, we're going to start by refreshing ourselves on net present value, or NPV. The net present value measures the net value of a stream of cash flows in terms of cash today. So if I were to make an investment decision, we would want the benefits of the investment to be more than the costs. This is the same logic that applies to any decision you make. Suppose you made a decision to buy lunch from McDonald's and it cost you $10. Why did you make that decision? I suspect the satisfaction you got from having McDonald's for lunch was greater than the cost of $10. Otherwise, you probably wouldn't have decided to purchase McDonald's for lunch. This, of course, is put very simply by saying the benefits were greater than the costs. So the logic behind this rule is that we accept the project when the present value of the benefits are greater than the present value of the costs. This will give us a positive net present value. If the present value of the benefits is less than the present value of the costs, then we will reject the project. This would give us a negative net present value. When making an investment decision, we take the alternative with the highest net present value. The net present value tells us the amount we would receive in terms of dollars today. Here we're going to have a look at a very simple example of applying the NPV Decision Rule. In exchange for $500 today, your firm will receive $550 in 1 year. If the interest rate is 8% per year, what is the NPV of this decision? The benefit received in 1 year is $550. So we need to calculate that benefit in terms of dollars today. So what we do is we divide our $550 benefit by 1 plus our interest rate. So we're discounting our benefit back 1 year. And what we get is a present value of $509.26. So the present value of $550 is $509. The cost to us today, the cost of this investment, is $500. That's what we must pay. So the net present value of this decision is our benefit of $509.26 minus our cost of $500, which gives us $9.26 today. So the way that we interpret this is that we say accepting this project is equivalent to receiving $9.26 in cash today. But what if you don't have $500 to invest in? What do you do? Well, you can borrow $509.26 today, and you can make the investment that cost you $500. So today this transaction will leave you with $9.26. And in 1 year, you're going to owe the bank $550. So that $550 is calculated as the $509.26 that we borrowed multiplied by 1.08, or 1 plus our interest rate. But recall that our investment will also return us $550 in 1 year. So this is essentially going to leave you with no obligation in 1 year's time. You're going to pay the bank back $550 and you're going to receive $550 from your investment. This table here will let you visualize the cash flows. So when it comes to topics like arbitrage, I like to set my cash flows out like this. So the cash flows in year 0, we can see that we receive a cash inflow of $509.26 from the bank when we borrowed the money. And then we experience a cash outflow when we invest the $500. So the cash flows, the net cash flows in year 0 is the $9.26. The cash flows in year 1, we can see that we have a cash outflow when we pay back the bank $550, and then we have a cash inflow of $550 that we receive from our investment. So our net cash flow in year 1 is $0. So here we outline again the intuition of the NPV rule. As long as the NPV of the project is positive, that is, the present value of the benefits are greater than the present value of the costs, then the decision to accept the project will increase the value of the firm. This is regardless of the current cash needs or preferences, as long as values are calculated using competitive market prices. Accepting a positive NPV project is equivalent to receiving the net present value in cash today, and therefore it will increase the firm value. For negative NPV projects, accepting them would actually reduce the firm value, whereas if we were to reject the negative NPV project, that would have no cost to us. That is, the NPV of rejecting this project would be 0. To begin with, we're going to look at the net present value rule for standalone projects. For a standalone project, our only consideration is whether the NPV for the project is positive or negative. Simply, the decision to accept this project does not constrain the company's ability to accept other projects. Of course, this is not a realistic assumption. Managers have to make decisions with limited funds and limited resources. So the manager's goal would be to choose the best projects, those that would provide the most value to the firm from a list of potential projects. And we'll take a closer look at this when we look at mutually exclusive projects. But for now, we're just going to be looking at whether or not a project has a positive or negative NPV and make our decision based off that. So here we look at using the NPV rule for a standalone project. A fertilizer company, Frederick's Feed and Farm, can create a new environmentally friendly fertilizer at a large savings over the company's existing fertilizer. The fertilizer will require a new factory that can be built at a cost of $81.6 million. The estimated return on the new fertilizer will be $28 million per year for 4 years. So when approaching these questions, we should always be keeping in mind what are the benefits and what are the costs? We should also be thinking, when do we receive those benefits and when do we pay those costs? This is where a timeline is very useful. So the decision to build a new factory is going to cost $81.6 million. That's our cost. The benefit from building the new factory is $28 million per year for the next 4 years. The NPV of the factory will equal the $81.6 million cost today. The negative value tells us that it is a cash outflow plus the present value of the $28 million per year. We can do this using the long way by discounting each $28 million cash flow back to the present value, or we can more simply use the annuity formula. Recall, if we have a constant stream of cash flows, we can use the annuity formula to calculate the present value. If these cash flows were changing from year 1 to 2, if it was $28 million in year 1, $32 million in year 2, $18 million in year 3, and $14 million in year 4, of course we would have to discount those cash flows the long way. We wouldn't be able to use the annuity formula. So now suppose the discount rate we use to discount the future cash flows is 10%. If we plug 10% into our formula on the previous slide, the NPV we get for this project is $7.2 million. Now, because this is a positive value, we should accept the project, as this will increase the value of the firm. Why 10%? Obviously, if we decided to use a different discount rate, our NPV answer would also be different. So what happens when you increase the discount rate? If you discount future cash flows by a higher rate, that is going to give us a lower net present value. In fact, if we increase the discount rate to 14%, the NPV of the project falls to 0. That sounds scary. An NPV of $7.2 million can become $0 with just a 4% increase in the discount rate. The NPV profile can be thought of as a sensitivity analysis. Recall from last week's lecture on equity valuation what a sensitivity analysis was. When managers make financial decisions, they do not know what the actual discount rate will be. That is, they make an estimate. The NPV profile shows how sensitive the manager's analysis is to error in the discount rate. Now you'll have this figure in your textbooks, figure 8.1. And this is essentially showing an NPV profile. An NPV profile will graph the net present value of a project for different discount rates. On the y-axis, we have the NPV of the project that we calculated as the present value of the benefits minus the present value of the costs. On the x-axis, we have different levels of the discount rate. For practice, you can repeat the last question using a 9% discount rate and an 11% discount rate. Compare your answers to the original, when the discount rate was only 10%. You will find that using a smaller discount rate will give you a higher net present value because our cash inflows, the benefits, are being discounted at a lower rate. Similarly, you will find using an 11% discount rate will give you a lower NPV. Moving across the x-axis, we can see that the discount rate increases. moving across the x-axis, we can see that as the discount rate increases, the NPV decreases. When the discount rate reaches 14%, the NPV is 0. We call this rate the internal rate of return. For any discount rate above the internal rate of return, the NPV is obviously negative. Keep this in mind because we're going to return to this when we look at the internal rate of return decision rule. The discount rate that makes NPV equal to $0 is known as the internal rate of return. The difference between the manager's estimated discount rate and the internal rate of return tells us the amount of estimation error in the estimated discount rate that can exist without altering the original decision. Specifically, if the actual discount rate exceeds the internal rate of return, the project would have a negative NPV and the firm would lose value. The NPV rule is one method managers may use to make an investment decision. This slide shows a survey of managers' use of alternative rules. We can see that the majority, 50%, responded with always use to the net present value rule. Other popular methods that are used that we will look at in this lecture are the internal rate of return, the payback period, and profitability index. Suppose you decide to use more than one rule for the same project. What if the rules conflict? That is, what happens if one rule tells you to accept the project and another rule tells you to reject? What rule should you follow? Well, it's quite simple. Because the NPV rule gives the answer that maximizes the most wealth in terms of dollars, we should always follow the NPV rule when the rules are conflicting. This slide shows another survey regarding managers' preferences of decision rules, and we can see that the most preferred methods are the internal rate of return, net present value, and the payback period. Here's a simple homework question for you. You can pause the video and try it yourself. So, alternative decision rules. So the first alternative decision rule we're going to look at is the payback period. The payback period is a relatively simple rule. We don't need to worry about discounting cash flows when we use this rule. The payback period rule is the amount of time it takes to recover or pay back the initial investment. So the rule for the payback period is, if the payback period is less than a pre-specified length of time, you accept the project, otherwise you reject it. Now, what is the pre-specified length of time? Much in the same way a manager needs to estimate the discount rate, a manager would also decide how long this pre-specified length of time is. So it could be 1 year, it could be 2 years, it could be 3 years, whatever the manager decides. And essentially the manager is saying, we want to pay back the initial investment in this time period. So let's have a look at an example. So back to the fertilizer example we saw earlier. We can apply the payback period rule to determine whether or not the project should be accepted or rejected. Recall that when the discount rate for this investment was 10%, the NPV was $7.2 million, which we would accept under the NPV rule. So to apply the payback period rule, we need to calculate the amount of time it takes to pay back the initial investment. This is called the payback period. Given this payback period, we would then only accept a project if the pre-specified length of time decided by the manager is less than the payback period. If the manager decided that the project needed to be paid back, if the manager decided that the projected, So now we've had a look at the net present value rule. We turn to an alternative decision rule, specifically the payback period. Now this is a fairly simple rule. There's not much to it, and we don't need to worry about discounting cash flows here when we apply it. So the first thing we want to define here is the payback period. Now, the payback period is the amount of time it takes to recover or pay back the initial investment. So the rule here is that if the payback period is less than some pre-specified length of time, you accept the project. Otherwise, you will reject it. And what is this pre-specified length of time? Well, much in the same way that a manager needs to estimate the discount rate, a manager is going to decide how long it should take or how long they're willing to allow a project to be running before it pays you back. So this will be made a lot more easier with an example. So going back to the fertilizer company we saw earlier, we can apply the payback period rule here to decide whether or not we should accept this project or reject it. So recall what the NPV rule said about this project. If we had a discount rate of 10%, the NPV was $7.2 million. So because it was positive, we accepted the project because it was increasing the value of our firm. Now, using the payback period rule, we would need to calculate the amount of time it takes to pay back this initial investment. So this is the payback period. Given this payback period, we would then only accept the project if the pre-specified length of time decided by the manager is less than this payback period. So having a look at this timeline of cash flows, our initial investment was $81.6 million. So how many years does it take to pay back that initial investment? Well, in year 1, we earned $28 million. Year 2, we earn another $28 million, so that gives us $56 million cumulatively. And then in the third year, we would have another $28 million, and cumulatively that would be $84 million. So it's not up until the third year of cash flows do we pay back that initial investment of $81.6 million. So if the manager decided that the pre-specified length of time was 2 years or less, we would reject the project because the manager says that we want the initial investment of $81.6 million to be paid back in 2 years or less. And notice that we're not discounting these cash flows, we're completely ignoring the discounting of cash flows here. And so of course this is one of the pitfalls of using the payback period, but it is very simple. So to see some of the problems with the payback period rule, let's have a look at an example. We start by calculating the payback period for the 4 projects A, B, C, and D in the table. And we rank these projects based on their payback period. You can see for every project, the payback period is 2 years. Project A costs $100 today and will pay $50 per year for 3 years. So the payback period, we can see that in year 1, we receive $50, year 2, we receive another $50, so cumulatively, that's $100. We've paid back our our initial investment in 2 years, or the payback period. So similarly, Project B costs $100 today as well, and it will pay $80 in year 1 and $20 in year 2. Again, the 80 plus the 20 covers our initial investment of $100. So again, the payback period here is 2 years. So however, let's suppose now that we calculate the NPV for all these projects using a 10% discount rate, and we decide to rank those projects based on their net present value. So we've got 2 rules here. We're going to rank them based on the payback period rule, and we're going to rank them based on the NPV. So ranking them based on the payback period, they are all equal. They're all 2 years. But ranking them based on NPV, well, Project C is earning us an NPV of $424.89. Project B is second most valuable at $37.50. Project A is next at $36, and lastly Project D at 72 cents. Now they're all positive NPVs, but we can see that the payback period has essentially said these are all equal. But the net present value has said something completely different, and there are some obviously more valuable projects. So the payback period rule is used by many companies because of its simplicity and its focus on liquidity. However, it does not always give a reliable decision because it ignores the time value of money. We didn't do any discounting. It ignored all cash flows after the payback period. So if we just go back, you'll notice that Project C has a cash flow of $500 in year 3. Compared to the rest of the projects, this is a substantial sum. So luckily for us, the NPV rule does not ignore those subsequent cash flows. We can see that Project C's NPV is $424 because it also includes all the cash flows. And it also lacks decision criteria grounded in economics, specifically how many years is required to pay back a particular project. So why does a manager choose 2 years or 3 years or 1 year? So the payback period rule, it's very, very useful for smaller projects. So, you know, should you purchase these new printers or something like that? Because doing a more thorough analysis, for example, using a net present value, it's a lot more costly. It takes a lot more time and resources. So for these smaller projects, it's probably not worthwhile, and it's better just to use a simple decision rule. So here's some homework, an example of a payback period question. Very simple, and I'll let you guys pause the video and have a go at that. I will put answers up to these homework questions, so never fear. But give it a go. It should be fairly simple. Now we turn to the internal rate of return, and we discussed the internal rate of return previously when we were looking at the net present value rule, or more specifically when we were looking at the NPV profile. And so recall that this internal rate of return is the rate, the interest rate, that makes the NPV equal to 0. So the internal rate of return rule tells us to make any investment where the internal rate of return exceeds the discount rate. We should reject investments where the discount rate is greater than the internal rate of return. And we'll go back to figure 8.1 so we can visualize this rule. I can understand that sometimes this rule can be a little bit confusing, but always go back to the NPV profile to understand, have a look where the positive NPV is for the discount rate and where the negative NPV is, and hopefully this rule will make a lot more sense to you. So the internal rate of return rule will give us the same answer, accept or reject, as the NPV rule in many, but not all situations. So this is where it gets a little bit more complicated. So it's important that we are aware of the pitfalls in using the internal rate of return, which we will cover shortly. So in general, the internal rate of return rule will work for a standalone project if all the project's negative cash flows precede its positive cash flows. So keep in mind, every example we have been looking at so far is for a standalone project. So having a look at the equation on this side, again, we identify our costs or negative cash flows, and they come before the benefits or our positive cash flows. And notice in this equation, we've actually set the NPV to equal 0. So all those discount rates you see in this equation, essentially that is the internal rate of return. So for Frederick Farm and Feed in the previous example, when the cost of capital, the discount rate, is below 14%, the project had a positive NPV and you would undertake the investment. And we can see this more obviously on the next slide. So again, going back to figure 8.1 in your slide, we will see that to the left of the internal rate of return of 14%, so that's all the discount rates that are less than the internal rate of return, we have a positive NPV. And we can see that more obviously on the table next to the NPV profile there. You can see that the NPV is highest when the discount rate is 0 at $30.4 million. And as we increase that discount rate, we can see the NPV fall. If our discount rate is actually greater than the internal rate of return of 14%, then our NPV will be negative. So have a think about what the internal rate of return rule is telling us again, is that it's telling us that we should accept a project if our cost of capital or our discount rate is less than the internal rate of return. If our discount rate is greater than the internal rate of return, our NPV is going to be negative and we should reject it. We should reject the project. So please note that when it comes to calculating the internal rate of return, there are many situations where you would need a financial calculator or something like Excel or the use of excessive trial and error to calculate the answer. So for example, if you were to look at this equation here, if we set the NPV equal to 0 and I asked you, well, calculate the interest rate or R, you're going to have a tough time doing that without a financial calculator or Excel or excessive amounts of trial and error. But never fear, I'm not going to ask you a question like this. I'm not going to ask you to calculate the internal rate of return if it requires you to use a financial calculator, Excel or something like that. If you are asked to calculate the internal rate of return, it means you can do so with a regular calculator. So if I ask you to calculate the internal rate of return for a perpetuity, if you recall the perpetuity formula, you would be able to do that. And so I may ask you questions to calculate the internal rate of return for something like that. But if it's a long string of cash flows, or you have to use, if it's in an annuity formula or something of the kind, I'm not going to ask you to calculate the internal rate of return for those kinds of questions. So, as I mentioned earlier, we need to be careful when we use the internal rate of return rule. So for standalone projects, most of the time it's going to give us the correct answer, meaning that if we accept a project when the cost of capital or the discount rate is less than the internal rate of return, that's going to increase the value of the firm. And if it's greater than the internal rate of return, the discount rate is greater than the internal rate of return, we reject it. That decision is going to be correct in most scenarios, but not always. So we need to be aware of when the internal rate of return rule is going to fail us. So for a standalone project, we really want to be careful of three things when it comes to the internal rate of return. Delayed investments. So for example, when the benefits or our cash inflows occur before the expenses, our cash outflows. So in all the examples we've seen so far, the costs occur today and we receive cash flows in the future. Non-existent internal rate of returns. So if there is no internal rate of return, essentially the NPV is never zero. So if we go back to our figure 8.1, imagine this curve here never intersects the x-axis, right? We would not get an internal rate of return in this case because the NPV is always going to be positive. And lastly, for standalone projects, multiple internal rate of returns. So in this situation, the NPV can be zero for more than one value for the discount rate. So we'll have a look at that as well. When we look at mutually exclusive projects, we also need to be worried about differences in scale and the timing of cash flows. Differences in risk is also something that we need to be aware of, but we're not going to go through that. So looking at the first pitfall of the internal rate of return, and specifically delayed investments. In this scenario, we see a decision that essentially we have $1 million cash inflow today, and that's followed by $500,000 cash outflow every year for 3 years. So essentially it's been reversed. We're used to having our costs incurred today and having cash flows in the future. So we are given a cost of capital of 10%, and we are asked to use the internal rate of return rule and the NPV rule to decide whether or not we should accept or reject this project. So to calculate the internal rate of return, we would be faced with an equation that looks a bit like this. And so to calculate the internal rate of return, we know that our NPV will be zero. So to do this, we would use a financial calculator or Excel to do it, and we would find that the internal rate of return is 23.38%. Now, using our rule, our internal rate of return rule, because the internal rate of return is greater than our discount rate of 10%, we would accept the project. So the IRR rule says we should accept. Great. So now let's calculate the NPV of this investment decision. We know the discount rate is 10%, so calculating the NPV is quite simple. So the NPV is equal to the $1 million we received today minus three $500,000 cash flows, each received per year, and we discount those back at 10% per year. And now what the NPV rule has told us, or the NPV of this project, it's negative. It's negative $243,426. So since the NPV is negative here, of course, we would reject the project or reject the deal. Now, this is where we have a conflict, and this is where we have a bit of an issue, because in the previous slide, the internal rate of return told us to accept the project because our discount rate was less than our internal rate of return. So we said we'll accept the project. However, upon calculating the NPV, we say we should reject the project because the NPV is negative. So if we were to actually plot the NPV profile for this project, so much in the same way as we saw the NPV profile in the previous slides, figure 8.1, for this project, this is what the NPV profile shows. And it essentially shows us immediately why the internal rate of return rule has failed. Just having a look at this graph, we can see that if our discount rate is less than the internal rate of return, we should reject the project because our NPV will be negative. Our NPV will be down in this negative area. And when the discount rate is greater than the internal rate of return, we should accept the project because our NPV is now positive. So notice the slope of the NPV profile and how it's changed. In the previous example, it was an inverse relationship, and now it's a positive one. So the NPV rule is essentially, it's completely flipped. So a good way to think about this scenario as to why, essentially we have cash outflows in the future. So if we discount those cash outflows in the future by a lower rate, then that's going to increase the present value of those cash outflows. So of course, we would want a higher discount rate for those cash outflows because we want our costs to be lower. So the second pitfall of the internal rate of return is when we don't have an internal rate of return. One does not exist. So now have a look at the following. It's a bit different. And what's different is we don't have a cost. We receive $500,000 every year for 3 years. So when we calculate the NPV of this project, when are we going to receive a negative value? When will we ever have a negative NPV? So you can see that if we plotted this NPV profile, the NPV never reaches zero. And take a close look at this discount rate. This discount rate goes all the way to 200%. A discount rate of 200%, and the NPV of this project is still positive, and it will continue to be positive. So another pitfall is when we do not have an internal rate of return. Now let's have a look at the last of the 3 pitfalls for the internal rate of return. So now assume that we have cash flows and those cash flows now contained at perpetuity. So the cash flows look something like this. We receive $1 million today, and then we pay $500,000 every year for 3 years, and then in the 4th year we receive a perpetuity where we get $20,000 every year forever. So to calculate this net present value, we would get something that looks like this, an equation that looks like this. And yeah, it looks a little bit messy, but if we just break them down, what we have is this $1 million that we receive today minus a cost of $500,000 per year for the next 3 years. And then here is our perpetuity of $20,000 every year forever. Now notice that we're discounting this perpetuity back, right? Because this perpetuity begins in year 4. And so this is the first cash flow, which means if we calculate the present value of these perpetual cash flows, the present value that we're going to be calculating is going to be at t equals 3. Which means that the present value that we have, this big number that we have for this perpetuity, we need to take back all the way to time period 0, which is why we have this discount rate here. So we're discounting the present value of this perpetual cash flows back 3 years to time period 0. Now this is a very important thing for you all to get comfortable with. So make sure you practice that. So this is what the NPV profile looks like if we draw it for these set of cash flows. Now you'll notice immediately that there are 2 internal rates of return. So if the internal rate, if our cash rate, not a cash rate, our discount rate or our cost of capital exists somewhere between 4.723% and 19.619%, we're going to experience a negative NPV. So that means we would reject the project if it existed between those 2 internal rates of return. Now, although the internal rate of return rule fails in this case, it still provides some pretty useful information for managers. So the internal rate of return still provides a range for which managers can be wrong in their estimation for the discount rate. If a manager expects the discount rate to be, say, 10%, then they know that the actual discount rate can fall to 4.723% or rise to 19.619% before the decision to reject the project changes. So it gives us a good idea of the sensitivity in estimation error of our discount rate. So we cannot really rely on the internal rate of return when there's multiple internal rate of returns. So notice in the last example here, when we had a look at the NPV, the equation for the NPV, that the cash flows are actually changing sign, or it's probably easier to see on this timeline. So the cash flows begin positive, and then they change to negative. That's one change, and then they change back to positive. So it's gone from positive to negative back to positive, and we can see that in this equation here: the negative sign, the cash outflows, and then back to the positive sign, the cash inflows. So the two changes in the sign, we're expected to get 2 internal rates of return. So there will be an IRR for every change in sign in the cash flow stream. So usually in an ideal scenario, we have our negative cash flows first, and then we have a sign change to our benefits, which are all positive, and we would have one internal rate of return. In this second example, our cash flows, they start negative, go to positive, that's one change, and then at the end they go from positive to negative, that's two changes. In this example, in the last example where we have 4 internal rates of return, we go negative to positive, that's one change, positive to negative, that's the second change, negative to positive, that's a third change, and then lastly positive to negative, that's a fourth change. So we're going to get more internal rates of return if our cash flows are changing signs, if they're going from positive to negative, negative to positive. So bear that in mind. So this slide nicely summarizes the internal rate of return and the internal rate of return rule. So the IRR at the end of the day really measures the average return of the investment. And it really gives us an idea as to the sensitivity of the net present value to any kind of estimation error in the discount rate. So what's the chance of us being wrong, and what will happen to the net present value if we are wrong? Here is another homework question for you to practice. And so I'll let you pause the video here and you can have a go at that. So now we move on to choosing between projects. So up until now, we've only been looking at standalone projects. And so what this means is that we haven't been worried about any kind of constraints managers might have to do with resources, really. But now we're going to move to mutually exclusive projects. So a mutually exclusive project is one where the acceptance of one project precludes the acceptance of others. So if we decide to choose one project, it means we can't choose other projects. So this is a realistic assumption because we are likely to have limited funds. We're likely to have a limited amount of land. We're likely to have a certain number of employees, and therefore we can't go ahead and accept every single positive NPV project that's out there. We just simply do not have the resources to do so. So the NPV rule here for mutually exclusive projects remains robust. For mutually exclusive projects, when we have to choose between, for example, 5 projects, we will simply just rank those projects and choose the project or projects with the highest NPV. So the projects with the highest NPV will create the most value for the company. But for the internal rate of return, we run into more issues, unfortunately. So in addition to the problems we saw before, the internal rate of return rule again, now we're looking at problems due to differences in scale and the timing of cash flows. So if we were deciding between 2 projects using the internal rate of return, well, recall from the last slide that the internal rate of return was essentially showing the average return on investment. So you might conclude and say, okay, I will choose the projects that give me the highest return on my investment. And that's ultimately going to lead to some mistakes. So to put that in an example, let's have a look at the differences in scale So for mutually exclusive projects, we need to consider the size of these alternatives. Because the internal rate of return it's a measure of return, it doesn't tell us anything about the size of the projects. So to put this in a very simple example, would you prefer 200% on $1 or 10% on $1 million? Now the former, although it's a 200% return, that's great, it's going to only make you $2. While the latter opportunity, 10% on $1 million, is going to return you $100,000. So the percentage return can be very high, but the dollar amount that you're earning can be trivial. So this is where the size of the project actually matters. The scale of the project is important. So when it comes to looking at two mutually exclusive projects or a list of mutually exclusive projects, we can't use the internal rate of return rule and rank the projects based on the highest internal rate of return. Because simply some might earn a small return on a large project and some might return a large amount on a very small project. So the problem here is that if we're trying to increase the dollar value of the firm, the scale definitely matters. The timing of cash flows is something we also need to be aware of. Even if mutually exclusive projects have the same scale, you may still rank projects incorrectly using the IRR rule, because there's differences in the timing of their cash flows. Now let's have a look at a very simple example here. So we've got project 1 and project 2. They both cost $100 today. Project 1, you will receive $150 in 1 year's time. Project 2, you're going to receive $759.38 in 5 years' time. So both these projects have an internal rate of return of 50%. However, the NPV of these projects are very, very different. So the NPV of project 1 is $36. But the NPV of project 2 is $371. And all that's changed here is that the timing of the cash flows have changed. So although the internal rate of return is the same for both projects, one yields a much higher NPV. So here's another example that describes the choice between two stores. So if you imagine that you're going to set up a store in a popular supermarket or popular shopping mall, there's obviously a limited amount of space that you can use. So you have a choice between choosing a coffee shop or a music store. Which one should you choose? So here's some basic information on those. You will notice that both the projects have the same initial investment of $400,000. The music store has a higher initial cash flow compared to the coffee store. So the coffee store only has $80,000 in year 1 and the music store has $104,000 in year 1. Both stores have the same discount rate of 8%, but the difference here is that the cash flows for the coffee store are actually growing at 3% every year, whereas the cash flows for the music store are not. So for both these stores, we say that the cash flows are going to run in perpetuity. We don't expect these stores to close down anytime soon, so we're going to calculate the present value or the net present value of these projects based on a perpetuity. So if we calculated the internal rate of return for both these projects, we would find the internal rate of return for the music store is 26%, which is greater than the internal rate of return of the coffee store, which is 23%. So comparing these two projects, if we were to say, okay, the internal rate of return is giving us the average return on the investment, then we would say, okay, the music store is better because it's 26%, which is greater than 23%. But the problem here is that we're ignoring the timing of these cash flows. So if we calculated the NPV, we can see that there's a difference in the NPV for the coffee store and the music store, and that difference is $300,000 in favor of the coffee store. So the coffee store has an NPV of $1.2 million, whereas the NPV of the music store is only $900,000. So this rule is telling us we should accept the coffee store. So another scenario where our internal rate of return rule and our NPV rule are conflicting with one another. So the reason here, I mean, of course we should choose the coffee store because we're going to base our decision off the NPV rule, but really the timing of cash flows is different because the cash flows for the coffee store, we actually have growing cash flows. So those cash flows for the coffee store are actually going to become greater than those cash flows in the music store. So now that we had covered some issues that the internal rate of return faces for mutually exclusive projects, we now turn to the incremental IRR rule. So using this rule allows us to compare two mutually exclusive projects by looking at the differences in their cash flows, hence the name incremental internal rate of return. So the incremental internal rate of return tells us for what discount rate is it profitable to change from one project to another. So consider the two options here. We have with a contract and without a contract. We compare the cash flows with the contract and the cash flows without the contract. So simply what we have here is that we have our timeline, we have our cash flows with and without the contract, and what we have in this third row is the differences between the two decisions. So in time period 0, the difference between these two decisions is $0. Then 150 minus 400, negative 250, and so on and so forth. So we're just taking the difference in the cash flows between two projects, and that's why we call it incremental cash flows. Now that's a really important term for you guys to remember for next week when we talk about capital budgeting, because we're going to be dealing in incremental cash flows, and you just want to think of it as the cash flows, the differences between two decisions, to accept, to not accept, project A, project B. It's just the differences in two cash flows. So the incremental internal rate of return for switching from with the contract to without the contract can be quite easily seen in this figure. So where these two NPV profiles intersect here, that is our incremental internal rate of return. So it's 12%. So if you follow both these curves, you can see that for any discount rate less than the incremental IRR, or less than the 12%, taking the contract, this one here, taking the contract, will give you a higher NPV than if you were to not take the contract. So you can see that this curve here is higher than the curve that shows the NPV without the contract. So as long as our discount rate is less than this incremental IRR, we should choose the maintenance contract, or we should choose to have the contract, because that's going to give us a higher NPV than without the contract. But notice that when we exceed this incremental IRR, that the NPV without the contract is actually greater than the NPV with the contract. So if our discount rate is actually higher than the incremental IRR, we should choose to go without the contract. And so this slide here, this one just summarizes the last one. So the incremental IRR is essentially telling us when we should switch from one project to another, or switch from one decision to another. So work your way through this slide. Pause the video for a moment. Again, in this video, in this slide, we're looking at two perpetual cash flows. So here is an example of where you would actually have to calculate the internal rate of return. You don't need a calculator to do this, financial calculator or Excel or anything like that. You can do this with a regular calculator. So if you were asked to calculate the internal rate of return, this is the kind of style question that you might see. So the fact that the internal rate of return exceeds the discount rate for the incremental project does not imply that both projects have a positive NPV. So this is a shortcoming of the incremental IRR rule. So the incremental IRR might also not exist. Those two NPV profiles may never intersect one another. We can of course have multiple incremental internal rates of return. But we should always ensure that when we're looking at the incremental rate of return, we structure our incremental cash flows such that they are initially negative and become positive. And of course, we are inherently assuming, when we're comparing these two projects, we're inherently assuming that they both have the same risk. And risk is a topic we're going to visit in a few weeks' time. So earlier I mentioned that we looked at mutually exclusive projects because managers, companies are going to have resource constraints. So they might have a lack of money or funding or limited funding, which might have limited space. So that's referring to the previous example, making a decision to choose between the coffee store and the music store. So we had limited space. Or employees. We've got a limited number of employees. If you think you've got a limited number of software engineers, there are only so many projects that you can undertake. So in this scenario where we realistically have limited resources, the manager's objective here is to allocate resources in a way that's going to maximize the value of the company. In other words, be most efficient with the resources that you have. So to do this, we're going to look at, or to analyze this, we're going to look at the profitability index. And the concept is simple. We want to have a look at how much net present value, how many dollars are created for every 1 unit of resource consumed. So in this example, we have 3 projects that require warehouse space. So of course, there's only so much space in a warehouse that we can use for our projects. So because we've only got one warehouse, we have to choose which projects can operate within that warehouse. We can't accept all the projects because we simply just don't have enough space. So our goal is to choose the projects that maximize the NPV for the amount of workspace used. So having a look at this, project A has an NPV of $100 million, but it also requires 100% of the warehouse space. So the profitability index here is our NPV of $100 million divided by the percentage of the warehouse that the project consumes, which is 100%. So our profitability index here is 1. It's 1 for 1. So $1 million per 1% of warehouse space used. For the other two projects, Project B and Project C, we can see that they both provide a net present value of $75 million. But they use relatively less warehouse space than Project A. So Project B only consumes 60% of the warehouse and Project C only requires 40%. So looking at the profitability index for projects B and C, we can see that they're 1.25 and 1.875. So this ratio is higher for project B and C than it is for project A, which is essentially saying that we're getting more in net present value. We're getting more in these dollars per amount of warehouse space used. So in essence, it's telling us that it's using the space more efficiently if we accept projects B and C. So luckily, in this example, project B consumes 60%, project C consumes 40%. Together, they would take up the entire warehouse, and taking their NPVs together, they would provide us with $150 million in NPV. So we can see that the manager here should choose project B and C because project B and C are going to be more efficient in using the warehouse space. And when I mean more efficient, I mean they're going to make the company more money. So to wrap up this online lecture, we're going to have a look at projects with different lives. So far, we've assumed that all these projects are going to last for the same amount of time. Again, that's another very simplifying assumption and not really realistic. So what do we need to do here? It's not so difficult. So to evaluate projects with different lives, we compute the equivalent annual annuity. And if you take one look at that formula, it might look a bit scary, but it also is familiar. This formula is just the annuity formula. And the EAA here is the cash flows in the annuity formula. So this formula here is just being rearranged to get it in terms of the cash flows, and we call those cash flows the equivalent annual annuity. So the intuition of using this EAA is that we can think of the cash flows for each project as the annual cash flows that will give us the same present value as the varying cash flows that we incur or earn when we make a decision. So having a look at a very simple example, we have two projects, A and B. They already have a present value calculated. So we have to calculate the present value of these projects first. So project A, we can see, has a present value of negative 12.49. And project B has a present value of negative 10.47. So you'll notice that all the cash flows here are negative. So in this example, this example's in your textbook, in this example we're looking at costs. So this is the cost, the present value of a cost of providing network server services to a company. So when we're making a decision on whether to choose A or B, we want to choose the the project that's going to cost us the least amount of money. So project A, we can see, or company A, goes for 3 years. So today, -10, and then -1 in year 1, -1 again in year 2, and -1 in year 3. So it goes for 3 years. Project B goes for 2 years. So we want to have a look at which project is better. Now, you might go ahead and conclude and say, okay, project B is better because it's got a lower cost, a lower present value cost to us of -10.47 compared to project A. But this would be a mistake because project A actually lasts longer than project B. So what we want to do is we want to calculate some cash flow that essentially standardizes this. What is the annual cash flow for each of these projects? So using this rearranged annuity formula, we can calculate the equivalent annual annuity for both option A and B. So for option A, it's -5.02, and for option B, it's -6.03. And so the way we interpret these figures is that option A is equivalent to spending, I'm going to say thousands, $5,000 per year, whilst option B is equivalent to spending $6,000 per year. So given option A has a lower annual cost, we would choose A over B. So we need to be careful here. We can see that if we looked at the net present value of these two projects, we might be quick to assume that project B or option B is better because it costs us less. But because these two projects have different lives, we need to make sure that we're evaluating them properly. So calculating the EAA essentially tells us what our annual cash flow would be for this project. So we need to calculate this NPV first and then rearrange it to calculate what the annual equivalent would be. So we would choose project A because it's costing us less per year. All right, that wraps up this online lecture. I hope I didn't drive you guys too crazy. Other than that, if you have any questions, please let me know. I will be more than happy to answer them, and thank you.